$18.6 billion. In one quarter, Nvidia bought stakes in private AI companies worth more than the previous 4 years combined, and the filing names not a single one of them, which leaves the question this 10Q is really about. Are Nvidia's customers buying GPUs because they need them or because Nvidia is funding them to? Hold that question. Everything else in this print is evidence on one side or the other. Start with the scale that makes the question worth asking. 81.6 billion of revenue this quarter, up 85% year over year, a fresh all-time record, and not a dollar of it from data center compute into China. A company this big, growing this fast, with this much cash coming through the door, has options smaller companies don't, including the option to send money in a loop. But the same filing also makes the opposite case. Take data center networking. The InfiniBand cables, the NVLink fabric, the Spectrum X switches that stitch GPUs into racks. That line grew 199% year over year, nearly $15 billion in a single quarter. Networking is now growing faster than compute, faster than the company itself, faster than anything in AI that isn't a chip fab. And nobody buys switches on Nvidia's dime. That growth is organic. Now zoom out to the full headline, 6 numbers, 5 all-time records. The one to look at twice is bottom right. Free cash flow at $48.6 billion in a single quarter, nearly double a year ago. That number is the reason the $18.6 billion outlay is even on the table. Gross margin at 75. Most of that gain isn't structural, and we'll come back to it. Operating income up 147, EPS up 140. Q2 already guided at $91 billion. These are the inputs the question runs on. The whole income statement in one picture, and both round trips visible with it. On the left edge, the $15.9 billion of equity gains feeding pre-tax income comes from paper markups on private companies. On the right, below net income, $18.6 billion of cash going right back into those same private companies. Loop 1. Same balance sheet, same quarter, money moving both directions on the same line. And $3 billion of incremental cloud commits to the very hyperscalers that turn around and buy GPUs. Loop 2. Money out, return arrow off the chart. Same logic now for the customer mix. Hyperscalers and public clouds with CapEx budgets that dwarf Nvidia's own, up 115% year over year. ACIE, sovereign AI industrial buyers, the AI clouds that aren't hyperscale, grew 74% year over year, 31 sequentially. Those are buyers with their own balance sheets. Nvidia isn't financing the Saudi sovereign fund. It isn't financing the German government. The data center mix is what the bull case is built on. And the supply chain confirms the networking story. Multi-year deals signed this quarter with Marvell on NVLink Fusion, plus Coherent, Corning, and Lumentum on silicon photonics. These are independent suppliers with their own incentives. They don't lock in years of capacity against demand they think might collapse. $5 billion to nearly 15 in 4 quarters. That's the most durable signal in the entire filing. Now back to those headlines, because one of them carries an asterisk. Margin went from 60.8 a year ago to 75 today. 10 of those 14 points are just lapping last year's $4.5 billion H20 inventory write-down. Strip that out, and the structural gain is 3 points, maybe 4. Q2 is guided flat at 75. So the durable margin is where we already are. Which matters because the $18 billion question only makes sense if the headline numbers underneath can be trusted. Some of them deserve a closer look. Operating expenses tell their own story. R&D up 58% year over year. That's not financing. That's silicon, Blackwell ramp, Vera Rubin spend, the agentic AI software stack. SG&A up 25. Combined OPEX up 52, but revenue grew 85, so operating margin still expanded even after absorbing it. One line buried in this OPEX matters separately: the internal cloud compute burn. We come back to that one in a moment. It's round trip number 2. Below the operating line is where the real spread opens up. Operating income grew 147% year over year. Net income grew 211. The 64-point gap comes from one line: 15.9 billion of gains on equity securities. Paper markups, not cash. And the markups are on the same private companies Nvidia is buying further into. So the same quarter, on the same balance sheet, the cash going out shows up as the 18.6 billion outlay, and the rising value of those same stakes shows up as net income going up. The accounting is correct. The optics are circular. 15.9 billion. Paper. The same names Nvidia just put 18.6 billion of cash into. Nothing about that combination is illegal. Nothing about it is even unusual in isolation. But it's circular by construction. And the question is what the next print does with it. Do those paper gains turn into realized cash, or do they quietly compress back down? Step back to where the cash actually went. 50.3 billion of operating cash flow in 90 days. Two slices dominate: 19.5 billion back to shareholders, 18.5 billion into private companies. Almost the same number. Nvidia is now treating its own ecosystem and its own shareholders as roughly equal weight uses of cash. That's a first. And it's why the 18.6 billion question isn't a technical asterisk. It's a structural shift in where this company sends money. Among those slices, the dividend is the most signal-rich. The quarterly payout went from 1 cent to 25-fold in one step. 80 billion added to the buyback authorization on top. Read this against the question. If management thought demand were partly financed and fragile, locking in a 24 billion a year dividend run rate is the last thing they'd do. Dividends are sticky. Cutting one is a brutal headline. So either the board genuinely believes this cash level is durable, which lands hard on the counter-evidence side, or they're courting income investors at exactly the wrong moment. The market is reading it as the first. The bears are watching. Round trip number 2, back to the cloud compute line we passed earlier in OPEX. Nvidia has locked in 30 billion of multi-year spend with the big public clouds for its own R&D capacity, up 3 billion this quarter alone. The mechanic is simple. Nvidia sells GPUs to AWS, Microsoft, and Google, then rents back compute on those same GPUs. Cash out, cash in, same names. The stated rationale is research capacity, reasonable enough. But it's the second line in the 10Q where the money loops. Now pivot to the other side of the balance sheet: 119 billion in supply commitments, fab capacity, long lead components, manufacturing slots. Nvidia can't easily unwind. Those aren't customers writing checks for the next several quarters. Those are Nvidia's own checks, which cuts both ways. If demand holds, this is the bull case made physical. If demand softens, this is the air pocket. Inventory ticked up 4 billion sequentially. DSO fell from 51 to 45 days. Customers paid early this quarter. The CFO says that normalizes next print. What comes next? 91 billion guided for Q2 plus or minus 2%. That's a 12% sequential jump from the record we just walked through. 95% year over year, zero China assumed. Gross margin flat at 75. Nvidia has been treating its own guidance lately as the floor, not the ceiling. And the China line is now structurally absent from that guide. A year ago, 4.6 billion of Hopper into China. Q4 0, Q1 0, Q2 guided at 0. Two things follow. 85% year-over-year growth despite the China line going to nothing. That's a signal about how strong demand is everywhere else, and it lands on the counter-evidence side of the question. And the setup is asymmetric. Any policy relief between here and the next print is upside that isn't in anyone's model yet. Beyond Q2, the pipeline is already on record. Blackwell Ultra carries the rest of this fiscal year. Vera CPU production starts in late calendar 2026. Rubin GPU ramp follows into 2027. Underneath that, the 30 billion cloud commitment and the 119 billion supply commitment span 2 to 3 years out. When management talks demand visibility, they mean a build plan they've already signed checks against. Which leaves the question for you. Is the build plan customers asking for chips or Nvidia leaning forward and hoping? Verdict time, 2 columns, both readings supported by the same 10Q. 5 conditions per side. The no column says the demand is organic. Networking growth carried by independent suppliers. Hyperscalers spending capex they raised themselves. Sovereign and industrial buyers writing their own checks. Nvidia betting $119 billion on its own balance sheet. The opposite of needing customers to bankroll it, and the 25-fold dividend which only a board confident in cash durability would commit to. The yes column is the mirror image, 18.6 billion into private stakes the filing doesn't name. 30 billion of cloud contracts to the very same hyperscalers, 15.9 billion of markups on the very same private names. China structurally zero. Both columns are honest reads of the same filing. The next print picks one. Until then, here's where this print actually moved the columns. 3 things moved green: networking compounding, ACIE diversifying, cash return commitment locked in. 2 moved ambiguous: margin durability once the H20 tailwind is gone, the inventory build versus the demand signal it might or might not be sending. 2 moved red: the 18.6 billion outlay. The question this video opened on, and the China gap now structurally zero for a second quarter. The greens are durable signals, the reds are the items the next 10Q has to actually address. 18.6 billion of cash out into private AI companies the filing doesn't name. 50 billion of operating cash flow generated in the same 90 days, same balance sheet, same quarter. One of those numbers is the headline story, the other is the question buried under it. If the 18.6 is catalyzing real third-party demand, the next 10Q proves it. With more networking growth, more ACIE expansion, more sovereign deals on independent balance sheets. If it isn't catalyzing anything, the next print shows up as inventory building and organic growth slowing. 2 more quarters, and the answer is in the filings. Subscribe if you want each one broken down the same way. Numbers first, narrative second, no hype. And drop a comment with the piece of evidence you'd weight heaviest on either side. See you next video.